Hello and welcome to our second quarter outlook on the economy and investment markets. If we haven't met, my name is Brian C. I'm glad you're joining us in these turbulent times. Investors have a lot of questions on your minds. I know there's lots of anxiety about what's going on in the world. Most importantly, everybody wants to know what the impact of Trump's proposed tariffs are going to be on the economy and to their investment portfolio. So in this episode, we'll talk about what I see as the two potential paths forward for the economy and markets based on what we know about the tariffs to date, and also what those different paths mean for your investments. So if you're joining via the podcast feed, there's lots of charts in this episode, so consider watching it on YouTube. It'll be there. You can see all the charts. So, all right, let's dive into the economy and markets as we move into the second quarter of 2025. Let's start with what's happened so far this year. On the chart, you can see the S&P 500 stock index in the red line. It's now down more than 13% for the year. Most of the decline coming in March, obviously, and then accelerating after the Liberation Day tariff announcements over the last week. Real estate and commodities have also sold off on the news as markets have started to adjust to a potential slowdown or a recession. And we'll talk more about the potential recession in a few minutes. You see on the chart, gold remains the top asset class for the year. Gold has sold off some in recent declines, perhaps opposite of what you might expect in an uncertain environment. But my bet is that has more to do with forced selling and deleveraging than sort of a decline in underlying buying from big investors like central banks. So we'll talk more about gold later on as well, but it's up a lot for the year. It's been a good diversifier in portfolios. It's also notable that during this decline, during the volatility over the last couple of weeks, bonds have done what they're supposed to do. The aggregate bond index is up 3.6% for the year. So that's rising slightly as risk to the economy increased. That's providing that stability and diversification in portfolios. So really, really important that you own something beyond just stocks. Perhaps even more important during times of trouble, the next chart shows long-term historical average returns for various asset classes. You see the recent decline in the S&P 500 on the far right edge of the chart. It's significant. It shows up on the chart when we look back over several decades. But if you invested right before COVID in 2020, you're still a happy investor today. If you invested right before the financial crisis of 2007, you're still a really happy investor today. When we zoom in a little bit and we look at just the past decade, the S&P 500 has returned more than 11% on average each year. Gold's now averaging almost 10%. Real estate has averaged 5%. Bonds are actually the laggard in this category, have only averaged 1.6% over the last decade. So as I mentioned, when you think about the long-term history, you'd be a very happy investor today if you invested at the peak of the markets before either of the major financial crises that we have experienced really since 2000, the financial crisis or COVID. So we'll talk about the current state of the U.S. economy and markets in a minute, but investing solely based on sort of what we will do, what our views are on whether we're going to have a trade war or a recession, it's really a bad idea. Recessions and market downturns don't feel good. I've lived through a few myself, but building a portfolio that you can stick with through the hard times is the best way to achieve those long-term compound returns that you see on the chart. Stocks are still compounding at rates far above what's required to meet most realistic investment goals. When you think about what's happened over the last couple of decades, over the last 10 years, sticking it out has been the most important thing, regardless of how things felt in the moment. When you think about 2020, that did not feel good, but over time, assets have continued to compound and grow. So regardless of the rest of this outlook, think about your portfolio and the other assets that you own and whether you feel comfortable owning those regardless of the environment, good or bad going forward. And if you're uncomfortable with your portfolio, then that's probably time to seek out some professional advice, get some help, make sure that you have something that you can stick with and that you don't feel the need to sell out of if we do have a downturn or more of a downturn in the second half of this year. At the beginning of the year, I made the case that returns would be harder to generate this year in 2025 than they were in the last 2 years, 2023 and 2024. The tariff discussion has only made the outlook more difficult. So let's look at some real data on the economy. Once we have a good feel for where the economy was prior to the tariff news, frankly, where it is today, then we can talk about the impacts of tariffs on the economy and the path forward for investors and for your portfolio. Real GDP, that's how we measure whether the economy was growing larger or contracting. Real GDP in the fourth quarter was growing at 2.5% a year, down from 2.7% in Q3, but still okay. You see the COVID recession in 2020, there was a big spike in GDP growth. That's the red line on the chart. That came with a big spike in inflation. That's the green line. And then the Fed raised the interest rates to cool off the economy. And growth and inflation have come down meaningfully from their post-COVID highs because of those, or at least partially because of those high Fed interest rates that have kind of put the brakes on the economy. And those brakes are still on the economy. We don't have the official numbers yet for the first quarter of this year, but you can see this is the Atlanta Fed's model, sort of a real-time tracker of GDP, and you can see that the economy is continuing to slow significantly. Most forecasters are expecting the economy will show either no growth in the first quarter or perhaps even a slightly negative print. The stats that come out are going to be really negative. A big part of that was people importing gold to get ahead of the tariffs, which counts as a negative for the way that we do the calculations around GDP, even though it's more of a financial transaction than anything representing the real economy. So there was a lot of gold that was imported from London into the States in January and February. So when you back out the impact of the gold trade, you still get something that looks at best like 0% growth for Q1, or maybe even perhaps slightly negative for the first quarter of this year. What I think is even more important is that slightly negative number that included a lot of buying to front run tariffs. Cox Automotive forecasted car sales for the first quarter of this year to be about 200,000 units above expectations due to the tariffs. Those are sales that won't happen later this year. So it's going to, while it helped sort of maybe get us to 0% growth in the first quarter, it's going to detract from growth as we move through Q2 and Q3. We don't know for sure about other industries like furniture and things until earnings come out later this month. But my expectation is that there was at least some pull forward of spend into the first quarter to avoid tariffs on big ticket items. So that means if we can only produce a 0% GDP growth number with the benefit of all those extra sales, GDP is going to likely fall into negative territory as we move into the second half of the year. So that's right, that's a recession. And two more points kind of here to set the table before I dig in on tariffs and potential recession impact. So economic growth has been held up by three factors as we've come through the last couple of years. Investment in AI infrastructure, that's been the first thing. A strong jobs market is the second thing. And then a wealth effect of lots of spending from very well-off consumers. Those are the three it's the three-legged stool of sorts that's held up the economy over the last couple of years and kept us from having a recession despite all that downward pressure that the Fed was putting on the economy via high interest rates. AI spending is going to likely continue, albeit at a slower pace. We saw it cool off in the fourth quarter, but folks are probably not going to stop, just go cold turkey on their AI investments. That's probably going to continue. But consumer spending, which is the largest component of the economy, is dependent on consumers having jobs. When you don't have a job, you don't tend to go out and buy stuff. But you can see in the next chart, the 3-month moving average of job growth continues to slow. Monthly net job creation now averages about 150,000 a month. You can see on the chart on the right, our jobs indicator is now slightly below zero. That's that big black line in the middle, meaning that means that more people are coming into the labor force looking for jobs than there are jobs available. That means the unemployment rate is going to start to rise. The economy can stabilize here. It's not flashing a red warning all by itself. If things don't get worse, then the outcome can be a continuation of the soft landing if we don't have a big shock to the economy. Of course, that's before we start talking about tariffs. The third support of the economy over the last couple of years has been spending from those high-end consumers. The values of 401ks, investment accounts, homes, businesses have all increased, and consumers tend to spend when they feel rich. That's normal human behavior. We won't have the full data for a couple months, but if we just use a broad market index, the recent decline wiped out about $5 trillion of U.S. equity value, and that's just in public markets. So that doesn't even include what's happening in private markets. So that sets us back to the beginning of 2023. So basically 2 years of value wiped out. That's real money. That's $41,000 per household in the United States. We know that stocks are concentrated among the top 50% of households. So that's likely to be a 6-figure difference in most people's investment accounts that has changed over the last, call it 3 or 4 weeks. So that seems to me like consumers are going to feel that, and it's going to change their spending. So that's the backdrop that we kind of take into Liberation Day, as they called it. I think the only thing that we were liberated from was the value of our investment accounts. But that's the backdrop that we take into Liberation Day for the tariff announcements from last week. A slowing economy, but perhaps stabilizing jobs market, and a reliance on spending from the top-end consumer that's spending their newfound wealth. So expectations, including mine, were sort of for slightly positive GDP growth this year, kind of tough, but kind of work it out. And then maybe single-digit type returns, just kind of getting by. Then we get Liberation Day and the tariff shock. So what did that executive order actually include? I talked about this a little bit in the kind of note that I sent out late one night last week. I'll break it down briefly into three parts here, and you can go back and watch that for a more fulsome discussion. But there's three parts in the order. The first is a 10% tariff on all of the goods that come into the United States. Part two is the quote unquote reciprocal part of the order. We'll talk about that more in a minute. That imposes specific tariffs on countries with existing tariffs and trade barriers that the administration deemed were higher. So that includes examples like a 35% tariff on China, 20% on the EU, 24% on Japan. Notably, Canada and Mexico are left off that list because most U.S. imports there are covered by the USMCA agreements. So those remain tariff-free. The third part of the executive order was specific to auto tariffs and metals. And that had already been announced a couple of weeks ago at 25%. So three parts, 10% minimum, but higher rates kind of ranging from 20 to really 40%. There's a few that are higher than that, but they tend to be smaller countries. And then those specific 25% rates for autos and metals. The more we hear Trump administration officials talk about tariffs, the more it seems to me like the 10% minimum and the tariffs on sort of the unfair trading partners are here to stay. So I think of 10% as the new baseline, and then anything above that is sort of based on their judgment of fairness of a country's trading practice. And I say their judgment intentionally. You can see in the chart, these are not reciprocal tariffs. Most countries, including the US, have tariffs on some goods. They tend to be in the low single digits. You can see examples in the chart. What the Trump team did was a back of the envelope calculation that essentially just took the goods trade deficit, divided by the foreign country's imports of US goods, implying that if the US trade, basically if the US runs a trade deficit with a country, they must be cheating by the amount of the trade deficit that we run with that country. That's not grounded in any sort of economic theory or, frankly, in good judgment. It seems sort of made up and contrived, to be really honest. If you want to start with higher tariffs to speed up negotiations, perhaps just call it a spade and say it's a high number. We sort of made it up. You can come up with a sort of a fake reason instead of releasing a formula that everybody instantly, understands means nothing. And just tell everybody we're starting really high and we're going to negotiate down, right? So I have no idea what they're trying to do here. This is not, importantly, going to eliminate the trade deficit. I've heard that from some folks say, oh, the point is to eliminate the trade deficit. I've covered tariffs in lots of other episodes. I'm not going to spend a ton of time here, but I'll give you just a short primer. You can check out the episode from last week after the tariff announcement, or I did a whole podcast on potential Trump policies from January, and there's a deeper dive in there on tariffs. But in short, so here's an example. Adding a 46% tariff to Nike shoes made in Vietnam does not mean that Nike's going to make shoes in the U.S. The price will probably go up 46%, and they'll sell less shoes in the U.S., and they'll hopefully sell more shoes in other countries with lower tariffs. It would cost Nike way more than 46% to bring their production back to the United States. The same is broadly true across the economy. Case in point, Apple today announced that they're going to make more iPhones where? Not in the United States, where rates are lower. They're going to make them in India. Why? Because they can get around the really high Chinese tariffs, and they can have lower tariff rates in India. So I'm supportive really of incentives that drive modern smart production into the US. That's a good thing. We want to create jobs here. We want to create modern jobs here, big robotic factories. All of that is great. Tariffs are just the wrong tool for that job. The Trump administration is currently hitting a screw with a hammer. They're sort of wondering why it's not working out. So regardless of your politics, tariffs act like a tax. They take money either from the goods producers or from consumers, and they funnel it to the government. Doesn't matter who pays the tariffs, whether the foreign people pay the tariffs, U.S. people pay the tariffs, consumers pay the tariffs, business pay the tariffs. You take the money out of the economy, you move it to the government. That's bad news for investors. I also thought we were all about making government smaller and having less revenue, but I digress. I guess that's a separate issue. So the focus here is the long and short term impact of the economy. So I'm not going to teach a class on tariffs. So we'll get to that in a second. We're going to take the tariffs for what they are at the moment and talk about some potential go forward scenarios and talk about the impact to the economy and portfolios. I'm not going to spend tons and tons of time on why we should or shouldn't have tariffs. There's lots of good information about that, like I said already, in some of our content that we've covered in other places that you can find. So here's what's going to happen. In the next few weeks, many companies are going to stop shipments and simply pause activity for a while to see if the tariff regime changes. Why would you pay a 70% import tariff on goods when you can simply wait a few weeks and see if the environment changes? Consumers tried to front load purchases, so now they're going to wait and see for larger big ticket items. So not a whole lot of that's going to happen in the next quarter. All of that's going to slow spending and economic growth in the second quarter, and it's going to slow pretty immediately. Over the next few months, if tariffs stay on, companies are going to do some combination of raising prices and cutting costs to hold their profitability stable. Say you run a business with a very healthy 25% margin, a new 75% tariff probably wipes out all of your profits immediately. So those businesses will lay people off, they'll change their models in an attempt to survive. Larger companies will economize as well. So it's not just sort of smaller companies that are this big corporations will do this. So you can read all of that as layoffs go up. Companies are likely not going to be able to pass on much of the tariffs to consumers who are losing jobs now. And they also just lost a big portion of their wealth in the stock market. They're not likely to just go pay higher prices for the same stuff. So that means profits take a hit. So if you're an investor, that's bad news. To the extent that prices do rise, the number of goods sold will fall because consumers can't afford to buy as much stuff. So we have an economy that's moving along at a stall speed, perhaps very slight growth before. Now we introduce all this badness around a recession, and now we are around the tariffs. And so now we have a recession. Numerically, if you want to get down to brass tacks and data, trade with China alone is $582 billion in 2024. That's about 2% of US GDP. Doesn't sound like much. But if you're growing at less than 1%, and say the new tariffs cause half of US-China trade to cease up for a quarter or two during a trade war, you now have a recession. It doesn't take that much to tip the US economy over into a recession when you're talking about numbers that are that big. That assumes that the other half of the trade sort of continues as usual, and the reality is the outcome's probably worse than that. So in my view, there's two paths forward from sort of where we sit today. The first is a recession with the current tariff regime. I think that's pretty clear that if things stay the way they are now, we're going to have a recession, and probably not a small one. Even a reduction in tariffs for all but a few major trading partners would not be enough here to stave off a recession. I think one of the things that we're likely to see is a bunch of deals with smaller countries. The reality is, if higher tariffs significantly reduce business activity between either the US and China or the US and the EU, we're going to have a recession. It's really those bigger trading partners that are going to matter. The smaller ones just don't move the needle enough. Even if there's a bunch of smaller deals, you got to have a deal with China, you got to have a deal with the EU. Otherwise, you're sort of cooked. So the second path, so path one is a recession with tariffs. The second path is a rapidly negotiated solution. And by rapidly, I mean weeks, not months. All that indecision I mentioned earlier will be sunk if we spend months debating the proposal. So if we get a deal by the US and its major trading partners by early summer, then perhaps we can avoid some of the worst case scenarios. Maybe we have a blip of a recession in Q2, and then we kind of power onward. One counter argument I hear cited frequently is, but Brian, all the good stuff is coming later in the year through the tax cuts. The tax cuts are coming. You just have to wait. You don't see. Here's the problem. The proposed tax changes being discussed are simply too small. The extension of the prior tax cuts simply maintains the status quo. So that's no stimulus, not helpful. What about tax cuts on Social Security payments? Well, income taxes paid on Social Security benefits conveniently go into the Social Security Trust Fund. So we know how much income taxes were paid on Social Security payments in 2023. That number was $51 billion. It sounds like a lot of money. Remember, trade with China alone is more than $500 billion. So the current tax proposals simply aren't big enough to offset the negative impact of a trade war. Taxing no tax on tips is similar. Taxes on tips aren't tracked publicly today. I would imagine a lot of tips, there still is some cash tipping that happens. So that's doesn't even go to the IRS. But what we know from looking at the tax incidence in the United States is that the server at your local restaurant isn't making a big payment to Uncle Sam every year, and rightfully so, because their income's not very high. So it's probably not billions and billions of dollars of sort of tax savings from not taxing tips, certainly not hundreds of billions, which is what you would need to offset the tariffs. So even if the tax proposals were enough money, so if you did something like cut corporate rates, something like that, the impact wouldn't be felt on the economy until workers receive those refunds in 2027 for the tax year 2026. That's 24 months from now. The damage will be done. So it's either a quickly negotiated solution or a recession. Those are the two options. My base case is now a recession. I hope I'm wrong. So maybe I'll be proven wrong, but I'm pulling for good things to happen, not bad things. But my expected outcome is a recession. So let's shift gears and talk a little bit about how this economic backdrop and a potential recession sets up for the stock market, the bond market, gold, and a few other asset classes as we move into the second quarter. I start with stocks because equity exposure generally forms the bulk of portfolios aimed at long-term growth. And when we think about portfolio construction, the major question is really how much stock exposure do we have Equities, both public and private, provide the bulk of that growth over time. And so after you answer that kind of important question on how much equity exposure you have, then you can fill in the rest with diversifying assets. So we started the year with analysts expecting about 12% earnings growth for U.S. large cap stocks, the S&P 500. As I mentioned in the 2025 outlook, I thought that was pretty optimistic. Everything had to go right for earnings to grow that much. Obviously, now everything is not going to go right. In March, earnings estimates already started to come down to around 7%. But we saw the stock market start to fall accordingly. You can see the results since the beginning of the year. The S&P 500 is now down 13%. Is that enough to offset a recession? I would argue that it's not. Estimates aren't updated yet to fully reflect all that tariff impact, but I think we can consider a conservative case where earnings are simply flat for the rest of the year, so they don't change from last year. And when they fall only 5% for 2024, just illustratively here, earnings have historically averaged a 13% decline in recession. So this assumes a very mild recession, but I'm just trying to make my point that I don't think the S&P's fallen far enough. In 2024, the S&P 500 earned $242 per share. The current multiple is 19 times earnings. So no growth leaves you with an S&P 500 that's 4,598. So that's down below today's levels pretty significantly. Another 500 points or so. We're at S&P 5,000 today. If earnings go down by 5%, the S&P can fall to 4,300 pretty easily. So, and that all that assumes the multiple or the price that we pay for future earnings remains constant. The multiple has already fallen from 22 to 19. So further decline to 16 or 17 is definitely on the table in a recession. So the market has not quite priced in a recession at the sort of total aggregate S&P 500 level. I don't make S&P 500 forecasts. I don't think they're all that useful for long-term investors, but understanding, and you've heard me talk about this before, the likely direction of travel is more important. And obviously my outlook for stocks is pretty bearish if the tariff situation is not resolved. International markets have held up surprisingly well so far. I think that has more to do with the sheer overvaluation of U.S. stocks and expectations versus sort of the weaker reality that has come to pass in the U.S. than it does anything superb going on abroad. Germany has announced more stimulus for its economy. That's a good thing for the Eurozone long term. I think that's now probably priced into stocks. I do think the U.S. remains the long-term driver of innovation and growth for the global economy. That doesn't mean, though, if we have a trade war, that international stocks can't outperform. The stock market is not the economy. International stocks are far cheaper than their U.S. counterparts. Thus, they should hold up better in a sell-off, and we've seen that so far. That doesn't mean they won't be down, but they could just be down less. Lastly, the Max 7 led growth in the market last year, and they've led the decline so far in the market this year. Growth has generally sold off harder than the broad market, again, owing to higher valuations. That's typically what we see in recessions at the beginning. But now those valuations have become more normalized. So I do think considering rebalancing back into growth stock allocations slowly may be helpful as the market continues to move forward. In a recession, growth stocks continue to drive innovation. They typically outperform as the broader economy falters. They're less dependent on their surroundings to drive their own profitability. They just need their own innovations to go well so they can continue to do well once we get sort of the price right, once that multiple gets corrected. Moving on from stocks a little bit, let's talk about the diversification part of portfolios. Perhaps never more valuable than the present time. So let's start with bonds and interest rates. So far, bonds have provided diversification in a falling market. The aggregate index is up more than 3% for the year. As rates have fallen, longer-term bonds have done even better than that. Those bonds haven't done much for several years, but they are providing a floor in portfolios, and they're helping smooth out volatility so far in 2025. The only real exception is high yield. I'll talk about that for a second. High yield has been a staple of our portfolios the last few years, but you can see the decline so far with just a hint of a recession over the past few weeks. Spreads, which is a fancy finance word for the difference in yield between risky higher yield bonds and safer investment grade bonds, that's still below historical average, but that spread can move much, much higher if we have a recession and the risk of defaults, company defaults increases. You can see from 2020 and 2008 that spreads can go much higher than they are today. And that means bond prices go down and they don't do the thing that you're expecting them to do, which is diversify away your equity risk. So from my perspective, this part of the portfolio, it's designed to diversify risk, not magnify it. So if there's a chance of a recession, it seems prudent to cut back on high yield credit exposure. So something to consider there. We started the year with the market expecting 2 Fed rate cuts, kind of sticky inflation, and of course, positive GDP and earnings growth. We talked about in our outlook earlier, that was kind of optimistic. The market's now pricing something closer to my base case for the year, which was 4 rate cuts by year end. That means the Fed funds rate falls to 3.5% by year end. I'm going to stick with that for now. Jay Powell made it very clear in a speech on Friday that the Fed was not going to bail out bad trade policy with rate cuts. And I think the Fed's hand ultimately will be forced, but that's not going to happen until the data gets worse on the employment side of the equation. That's probably not going to happen until over the summer. And so that means they've only got a few meetings left. So I think maybe they cut 1% in total by the end of the year. So that means bonds probably produce total returns something in the 5% range to 7% range for the year if we have a recession. So that will provide at least some offset for negative stock returns. What about other assets outside of bonds? Gold has provided good returns in a challenging environment so far, up about 12% for the year. My overall view on gold hasn't changed. As long as central bank demand remains above average, which it has, then gold should continue to do well. We've seen inflows from investors recently too, as market volatility has increased. Not surprising. That's typical. Gold fell during a few of the biggest down days last week. My view is that was probably more forced selling that was happening on those days when leveraged investors, hedge funds, highly leveraged ETFs, things like that, have to meet margin calls, and they don't have stocks to sell because those stocks have gone down in price, so they sell what they can, and that's their gold. So I don't see a reason why gold would underperform in a classic recessionary scenario over the medium term. So I think gold is still a good diversification asset to own. I covered real estate and crypto in my 2025 outlook, and my views there haven't changed. So you can go back. That was released back at the end of December, going into January, for a more detailed view of crypto and real estate. I'll just talk briefly about them here. Generally, investment in real estate is tricky going into a recession. Short-term rentals need to be in a place where demand is not susceptible to drops in consumer spending. Commercial properties need to have tenants that can continue to pay their bills and not go bust. It goes back to underwriting those transactions. I do think there are opportunities in the current market where you can find properties with forced sellers, where new investors can get a really good deal, but that's what I would be shopping for, not real estate investments more broadly. I'd be really careful about that and selective. Crypto, as you would expect, is down in line with the growth stock side of the stock market. So again, crypto is a levered bet on risk taking. It's not an asset for diversifying equity risk away or something to hold in case of a recession or the world goes to hell in a handbasket. That's not why you own crypto. All right, so I'll try to summarize it all more succinctly here. So my view on the economy sort of skating by without a recession has evolved, and I'll see that as the recession as the most likely outcome for the rest of the year. The driver of that is the trade war. If the tariffs are removed quickly, then perhaps the economy can move on. The outcome is very binary. Stocks have priced in a lot of that risk already, but there's likely more downside if a recession emerges. Also, the outcome is very binary and dependent on those tariff discussions. Today is Monday, April 7th, and the market moved up 7% in a matter of minutes this morning on a false news story that broke about a 90-day delay in the tariff implementation. So trying to time the ups and downs is a very difficult game to play. You likely will not be able to get back in fast enough if positive news comes out, or conversely sell out fast enough if negative news hits. So that means diversification is more important than ever. That means you need to own lots of different kinds of assets, a mix of assets like stocks, bonds, gold, real estate, other assets that can mitigate a market drop. That's really, really important. So nobody can predict the future. So it's a really important time just to stay focused on your long-term investment goals. Own a portfolio that can weather whatever sort of short-term volatility we have, so that in a few years we can look at the charts like we started with at the beginning and we'll say, hey, it was a really tough time to invest in 2025 with the tariff scare, but we got over it and now we have all this long-term compounding that's happened since then. So you want to stay the course. You want to have a portfolio that can help you do that. If you have questions, if you want to talk to us, certainly reach out. Our contact information is in the show notes. You can set up time online on our calendar if you'd like to have a more in-depth conversation about any of this content. And that's it for this episode of the Capital Stewards Podcast, and we will see you next.